Hello, everybody, and welcome to this latest weekly market recap for the week ending February 28th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and it's a pleasure to be with all of you again this weekend. Kind of a weird week last week in the market. I've been pretty cautious over the past month, maybe 4 to 6 weeks. And I think you're seeing a little bit of that cautiousness now starting to pay off a little bit as we see the major indices start to roll over, especially many of the names on the NASDAQ. Some of the big Mag 7 stocks took it on the chin last week, have been kind of rough. Many software, semiconductor stocks, especially software stocks, getting hit hard in the past few weeks. Even companies coming out with decent earnings really struggling a little bit. Oops. So we'll have to kind of just monitor that, as we go forward, see if we get some bounce back in some of these software names. But yeah, I mean, it was a rough week. And from an economic standpoint, starting to see more concerns about the economy. I know the Fed keeps talking about inflation, but I think the bigger risk is the economy than inflation. And I think, the Fed probably should be switching sooner rather than later in terms of trying to find, I guess, intestinal fortitude, if you will, to start cutting rates. But we had the consumer confidence come in way below expectations last week, 98 and change, I think, versus the expected one. I don't remember what it was, 103, 105. It was well below expectations. New home sales plummeted much below expectations. That was not a good sign. We had durable goods actually got a bounce back in durable goods in January, but that was after we had really horrible durable goods reports back in November and December, and that tends to be pretty volatile. So it was good. The January report that came out last week was good, but you just have to take it in context and realize that it followed 2 horrific months. What else did we have? GDP, second estimate was out last week. That came in as expected, so no big changes there. Initial jobless claims came in over 240,000 last week. I think the expectation was for about 224,000. So that wasn't good. Another sign of a crack in the foundation of our economy. Then I think January pending home sales dropped 4.5%. And the prior month's pending home sales were revised higher, better than they were. But they were minus 5.5%. They lowered them to minus 4.1. So our last 2 months of pending home sales for January and also for December have fallen. For December, they fell 4.1% revised. And then in January fell another 4.5%, or maybe it was 4.6%. And that was the worst on record, by the way, for pending home sales. So that was, again, not good news. And that's what the market's trying to deal with right now is, the Fed's telling everyone that we've got this inflation problem still out there. And now we've got the economic problem surfacing, and you can only fight one of them. Can't go after both of them. Fed's got to make up its mind. So they got to decide which one they feel is more important. And let's just hope they get it right. What else? I think that was probably it as far as the economy goes. We did see, in terms of sentiment, though, we saw the volatility index rise over 20, closing up near 22 on Thursday and then coming back a little bit on Friday. But generally, good things don't happen in the stock market when the volatility index is up at 20 or above. So we need to see that volatility index come down. Again, we did reverse a little bit lower on Friday, but we need to see that coming down quite a bit to feel better about the market. Otherwise, and I think maybe the way to look at it is just a lot of traders on pins and needles. And when you look at the volatility index, that's a sentiment indicator that's being given to us by market makers. Market makers are the ones that price options and determine what the premium is going to be on the options. And when those premiums are high, that's basically what the VIX is measuring. And so when the premiums are high, the market makers are essentially telling us that we got volatility ahead. And when you talk about higher volatility, it's almost always associated with lower market prices. So we got a lot of issues going on in the market. And, it's going to take a little bit of time to work through this. And that's why I said, I said back at the beginning of the year, I thought Q1 would be a choppy, difficult, challenging market. I thought we could maybe see as much as a 10% correction. S&P 500 was down 5% last week, or not last week, but at last week's low, it was down 5% from its all-time high. So, we're already halfway to what's defined as a correction, which is a 10% drop. So it really wouldn't take much more selling to get there. But anyway, let's take a look at the market action, and we'll go from there and check out what was happening last week. So you got the Dow Jones Industrial Average rising 412 points back to 43.8. So you can see it was a little bit bifurcated last week. We had, many of the larger companies, more value-oriented companies on the Dow Jones performing quite well, more than making up for some of the technology names that got hit. S&P 500 mid-cap was relatively flat, down just a bit, along with transportation. S&P 500 was down 1%, which on the surface doesn't seem that bad, but you have to remember Friday, the S&P snapped back 1.6%. So this number was more like 2.6% heading into Friday's open. So it was a rough week as we, went throughout the week until we got a little bit of, relief on Friday and saw some buying. Russell 2000 down another 1.5%, and the NASDAQ. And the reason, I'm going to show you the reason why the NASDAQ was hit so hard. NASDAQ down almost 3.4% last week. And again, that was after Friday's advance, which was, I think, at least or somewhere around what we saw on the S&P 500. So we were probably down on the NASDAQ 5% or more last week going into Friday. That's a big drop. And again, I'm about to show you here. I'll show you in a minute, what triggered that. But first, let's take a look at these indices. So here's the Dow Jones going down and then reversing back here, printing a pretty nice candlestick on Friday, actually closing at the high of the week in terms of the daily closes, and the highest close we'd seen since the big gap down in the prior week, heading into the weekend. So that big Friday drop. We actually came back up and closed above all of that. So the Dow actually performed pretty well last week, and that was the exception to the rule. Looking at the S&P 500, there's that Friday gain of 1.59%, and I'm seeing a piercing candle, which is a reversing candlestick off of a downtrend. So I think this at least sets us up. Doesn't guarantee us, but it sets us up for maybe a rally early part of this week. Let's cross our fingers, see if we get a little bit of a rally. But you still got to pay attention to the recent lows that were taken out. I think, you're getting back up to 59.75 to maybe a little over 6,000, testing the 20-day moving average, which is 6,015. I think all of that's going to be a little bit difficult. So I'm not seeing a huge rally on the major index, but, we can at least hope we get some to start the week, and then we'll kind of go from there, I suppose. Next, NDX. So the NDX, you can see this close down here, almost 20,500 on Thursday, which was the lowest close that we had seen on the NASDAQ 100 since back in the middle part of November. So we're talking about 3.5 month low on the NASDAQ at Thursday's close. Got a little bit of a bounce back. Looks like maybe it's a piercing candle. Doesn't look quite as bullish as the S&P 500. It didn't come back and cover up, didn't recover as much of the selling from Thursday as we saw on the S&P 500. Take a look at that again. See how this hollow candle comes up, and it's not quite an engulfing candle, but it gets close to being an engulfing candle. It's getting back close to the high from the prior day on Thursday. And then the NASDAQ 100, you can see not quite as strong. So, but the NASDAQ holds many of those Mag 7 stocks, higher percentage of those Mag 7 stocks. And that's what I'm going to show you here in just a couple minutes, taking a look at that. But here, mid caps, big reversal here now. Mid caps had some, I'd say some pretty good support around 30.75 up to 3,100. And we went just a little bit below that close there on Thursday. And then we made that reversing candle, another piercing candle showing up. Looks like a head fake. Maybe we recover. This is an index that has the falling 20-day moving average below the 50. And again, this is one of those configurations where it's not good. I mean, not much good happens trading below the 20-day moving average when it's below the 50-day. We've got to reverse that. We're not going to be in an uptrend until that gets reversed. As long as that trend is in play, we're in trouble. So short term, we're in trouble. But we did get a reversal. Maybe we get a little bit of strength to start the week. We'll see how much strength we get, if we get it, and whether or not we're able to clear some key moving averages there. Now, keep in mind, as you sideways consolidate, you normally do fall below moving averages, go back up above them, fall beneath, go back above them. So simply getting back through the moving averages doesn't guarantee us that all this weakness that we've been seeing and all the hesitancy is over. It certainly doesn't mean that the selling we saw last week in some of the key areas of the market is over. But if we can get back through those moving averages, it would make it look more like sideways consolidation. If we go up and we test those moving averages and then break back down to new lows, to me, that's an indication we have a downtrend in play, one that's likely to get worse. So that's why, to me, it's key to kind of follow the price action on this bounce. IWM, same as the mid caps, very, very similar. Had great support in that 214, 215 area. Told members this past week, if we get down below, I think it was Tuesday's low around 213.50 or 213.40, something like that, that could set up a much bigger drop. And we did fall with the VIX rising into Thursday's close, but we got a nice little kick save on Friday, piercing candle. Again, this is the bulls' maybe last hope to get something going back to the upside. And if this doesn't work, I'm looking at, September low. I'm looking at the August low, even possibly the April low. That's all the way down at 190 on the IWM. We don't want to go back down there. All right, let's keep moving here. Here's the Mag 7 last week. Now, I'm going to show you the sectors in a minute. You're going to be surprised when you see the sectors. Most of the sectors were up last week. But the ones that house the Mag 7 stocks didn't have a very good week. And here you can see Apple, the best performer of the 7, losing just 1.5%. Again, remember, there were some big reversals. We're going to look at these charts in just a second. Big reversals on Friday. These numbers were looking a lot worse Thursday afternoon or even Friday morning on many of these stocks. So Apple, Amazon held up pretty well. Meta and Microsoft, the same. Microsoft's been under a lot of pressure, though, prior to this. Meta actually went down, and I don't know if we hit a 52-week low or just approached it, but Microsoft's been under a lot of pressure. But look at the last three: Google, NVIDIA. NVIDIA had their earnings last week. That was their chance. We had a potential catalyst for the market. NVIDIA gapped up, and that was it. We had a gap up. We had decent earnings. We had a gap up, and then the selling took over again. Tesla, just been Tesla. Tesla probably the most under pressure, even maybe more so than Microsoft. Certainly in the near term, Tesla's been hit very, very hard. But we did get into a gap support area on Tesla. So looking at these 7 charts real quick, here was Apple. Nice reversal. You can see Friday we were down quite a bit. Came all the way back up, finished about $10 or $11 off the low. Then we had Amazon, been in a steady downtrend for the past month, but still holding on to what I consider to be longer term support. I would have liked to have seen 215 hold, but I think this 195 area, this is when we broke up above 200 for the first time. And then we went back and set a low at 195. I really believe that 195 low is going to be critical for Amazon to hold, and I believe it will hold it. All right, here's Google or Alphabet. Big decline. Tried to reverse, got close to key support down at 164, got even better support down around 160. I think eventually we go down there, but here's a perfect example of the 20 coming down below the 50. We're now well below the 20, which is well below the 50. The daily PPO is pointing straight down, meaning that bearish momentum is accelerating to the downside. Got to be really careful here with Google. If we do get a bounce, anything close to the upper 170s to around 180, and I'd be very careful getting prepared maybe for yet another drop coming. Next up, Meta platforms. You can see Meta coming down. Meta still looks pretty good. Nice reversal there off the 50-day moving average, holding on to the double top breakout. That would be your support level, down closer to 625, 635, but a very, very nice reversal on Friday with Meta. Microsoft, you can see Microsoft just down. Here were the 52-week lows down at just under 385. We actually got down to 386 last on Friday on Microsoft before reversing. So the good news is we reversed. The bad news is you can see we already failed once at the 20-day, which was declining. And so until, we can get through, say, I think we're going to have resistance at around 405 to 408. Maybe with a reversal, we can get Microsoft back up into that area. But I think we're probably going to come back down and test this August low. NVIDIA, you can see there was a little bit of gap up with its earnings, came out on Wednesday. So there was your Thursday morning gap up and sell off. Went down to 116 and change, got close to the lows that we've seen around 115 so far, holding that. Going to try to make a move back to the upside. Really need to get back up through 135. Got some work to do there. Here was Tesla moving down. You can see hitting this gap support area. Also coming across, it was like this triple top between about 265 and 275. We made a breakout with the election back in early November, heavy volume. That's where we took off from. So I'm looking at 265, 275 as pretty key support. Friday's low, 273.60. So is that the end? I don't know. You can see kind of like Microsoft, we've already seen one failure on a rise back to the 20-day. The daily PPO is very weak, showing accelerating momentum to the downside. So I think getting back through 325 and especially 335 to 340, those are going to be a couple really tough tests for Tesla in the near term. If that's assuming, we closed at 292. There's nothing saying we're going back to that level, but if we do, that's going to be an key area of resistance, in my opinion. All right, let's move on to the sectors. So here I show you 7 sectors that finished up last week, 4 that finished down. But you can probably guess the areas just looking at what happened in the major indices. You can probably guess which areas did well and which ones didn't. Many of the value-oriented areas, financials, real estate, healthcare, industrials, staples, materials, energy, they're of course more neutral, did fine. But then you look at the 3 main aggressive groups, communication services, consumer discretionary, and technology, and they're all at the bottom. They're 3 of the 4 that fell last week. So there's no doubt that this was a move away from the Mag 7, away from technology, away from software, and into other areas of the market. And I believe, and I'll talk about this in just a few minutes, I believe it has more to do with the economy than it has to do with inflation. So I wanted to pull up within the financial space. I wanted to just zero in here on this full line insurance group because obviously up 8% last week. So here's the good news. I've said before, I don't believe this is the end of the secular bull market. I think the secular bull market's going on, and whatever we have right now is just part of it. You don't go up every day in a secular bull market. You have periods, you even have cyclical bear markets where you go down 20% or more within a long-term uptrend. And that's what we talked about in 2022 before the year started, that, hey, looked like we were set up for a possible cyclical bear market, but that at the end of it, we were going to come right back up and go to all-time highs. I feel similarly during this weakness, I believe we're going to come back and go to all-time highs, but I don't think we're going to go to a cyclical bear market. I don't think it's going to morph in that deep. I could be wrong. I think if the Fed continues to make wrong choices and keeps waffling and gives this brief economic weakness a chance to really start to develop before they start cutting rates, then I think that could lead to something a little bit more in terms of the selling, at least a correction, maybe a cyclical bear market. Again, I don't think that's where we're headed, just based on what I'm looking at in the market, especially when you see all of this money pouring into other areas of the market. That's really good news. And that's a silver lining in all of this, is that we're selling off in certain areas that previously had gone up a lot. They're allowed to sell off sometimes. Got to keep perspective in mind. So I think this is setting up for some of those stocks to continue a sell-off. But the fact that that money is finding a home in the stock market in other areas, that's bullish rotation. So, some of it, we don't want the market to go up and set new highs with money rotating. That's what we just did. That wasn't good. And you can already see some of the fallout from that. But when the market's going down, it's okay for money to move into value-oriented or defensive areas. In fact, that's what we almost always see. Because when the market is truly selling off, a lot of the companies that made the biggest moves, the more aggressive companies, are the ones that get hit the hardest. because that's where all the profit taking comes from, right? Should make sense. Anyway, I really like this rotation into these financial stocks because what did I talk about at the beginning of last year and then again this year? I believe rates are going to continue to move lower. And I've said it all along. When you start getting a Fed funds rate that's dropping, you are instantly putting in or putting money to the bottom line in many banks' pockets and other financial companies' pockets. And I just saw this past week that they said that the earnings for the first quarter or earnings for the fourth quarter of last year, which just came out, showed that S&P 500 companies their earnings rose 17.8% year over year. Market was only anticipating like 11 or 11.5% going into the quarter. So earnings were really strong. The biggest earnings growth area, financials. They gained 56% earnings year over year because of that lower interest rate environment, because of the anticipation of those lower rates and then actually getting those lower rates. That's what we saw in the fourth quarter. Fed funds rate came down a full percentage point, 3 cuts, 100 basis points. What happens? Financials, their earnings grow 56%. Did we not discuss that throughout 2024 when rates started coming down? Financials have continued to do well. And I think they're going to continue to do well because I believe we're going to see rates cut further later in 2025. Hopefully on the sooner end rather than the later end of the year. We'll see what the Fed does. I'm not going to talk too much about the Fed today, but I do think we're going to get more rate cuts down the road. And already you're seeing what happens when rates start dropping, when the short-term rates start dropping. That's borrowing costs for banks in particular. That's how they get their money. They get their money. They borrow from the Federal Reserve. They borrow from other banks using the Fed funds rate. So when that rate drops, more access for banks and wider spreads. That's the product, if you will, in banks, wider spreads. Anyway, but I really like the full line insurance group because I'll show you this chart. Look at the last year. Look at all the tops coming in right at about 77 to 77.5, maybe even all the way up to 78. This 77 to 78 range was tested probably about 10 times over the course of the last year. Look what happened on Friday. So yes, money is rotating. Money is moving out of some areas of the market. Some areas of the market are getting absolutely killed. We'll talk about Palantir in a little bit. It was $124. It got down to 80. Maybe it was in the upper 70s. Just in the last couple of weeks, week and a half since options expired, just before options expired. And yet we're seeing that money rotate in areas like full line insurance and other financials that I just showed you on the screen. So it's not all bad out there. And that's, I really want to focus on that. The other thing I want to show you on the full line insurance is check out this seasonality chart for the last 20 years. So this goes back all the way back during the financial crisis and then forward. And I want you to look pretty clear. April's the strongest month seasonally for full line insurance. Been up 84% of April's in the last 20 years. So that's like 85%, 17 out of 20. And part of that is we haven't had April 2025. So I'd actually have to drag this back 1 year there. Now it's 80% because there was no April in 2025. So there were only 19 Aprils. That's why that percentage was 84 instead of 80 or 85. So anyway, 16 of the last 20 years, we've seen April go up. And so if we drag this back over, anyhow, looking at the percentages here at the bottom, March averages going up 3.1%, April 4.4%, January and February not so great, but we literally on the last day of February just made a breakout as we head into March, and we have the 2 best months coming up for full line insurance. So I'm going to feature a chart in the full line insurance area in Monday's EarningsBeats Digest newsletter. So if you are interested, go over to EarningsBeats.com, both plural, EarningsBeats.com, scroll down, and you can sign up if you haven't already This is a free newsletter, no credit card required. We send out an article Monday and Wednesday. It's really not an article. It's 2 paragraphs in a chart. Very simple read. Name and an email address, all it takes, sign up. Tens of thousands of folks have subscribed to our newsletter. Again, there's no credit card. You're not going to ever have to give your credit card for this. And we just talk about a lot of things that are important to us and things that we're seeing in the market, kind of like Full Line Insurance making a breakout. What stock is set up to benefit from this? Check in. I'll give it to you tomorrow morning on Monday, but make sure you sign up if you haven't already. All right, moving on. 10-year Treasury yield. So the 10-year Treasury yield, you can see the big advance back in December and into January. Very, very big advance. Remember what happened in December and January on the pending home sales. Just talked about it 15 minutes ago. Pending home sales got absolutely crushed the last 2 months. One of the reasons is that rates took off, went from just over 4.1% all the way up to just over 4.8%. That was in just over a 1-month period. Huge move to the upside. It's going to be harder to sell your house to folks looking to buy when the 10-year Treasury jumps like that. Why? Because mortgage rates basically are heavily positively correlated to the 10-year Treasury yield. So when the 10-year Treasury yield, is going up like this, normally we're going to see mortgage rates jumping like that as well. So we did see a big spike in mortgage rates, but now we're starting to come back down. And this right here is very interesting because I think this is a signal to the Fed, right? If you are, the Fed has to decide, are you more worried about inflation? If you're more worried about inflation, you sell bonds, yields go up. Or are you more worried about an upcoming possible recession? Because if that's the case, you would normally buy bonds and the yields would go down. Bond prices would go up, yields would go down. So what message is the bond market sending right now to the Fed? I mean, I think it's pretty clear the yield's gone from 480 down to 420. If you're worried about inflation, would you just keep buying bonds and sending the yields lower and lower, knowing that inflation's going up? Would you rather have a 4.2% 10-year Treasury yield or 4.8% Treasury yield if you're a bond investor and you're worried about inflation? Hopefully you'd say 4.8% because you're going to want to make more money in order to offset what you're going to lose in purchasing power, right? So for the last 6 weeks, 7 weeks, we have seen yields dropping considerably, which tells me the bond market's much more concerned about what's going on in the economy right now than about inflation. So I think the Fed needs to focus on some things outside of just looking at whether or not the core CPI ticks up 0.1% or not, or 0.1% higher than it was expected. The other thing is, with all the economic weakness signs that I went over at the beginning of the show, and some others out there as well, that's going to hold down inflation. With a recession, you have lower demand. That will take the demand issue out of the equation. So I think the Fed better think long and hard about how long they keep rates unchanged, especially if we keep seeing deterioration in some of our economic reports. Okay, so let's take a look at some of these sustainability ratios that I like to follow and areas of the market. I mean, it's pretty clear to me when you look at the iShares Russell 1000 growth. This is the large cap growth. This is going to be all of the Microsofts and the Apples and the Nvidias out there. When you look over the course of the last 2 weeks, you can see we've gone from threatening an all-time high to a 3.5-month low in just the course of these last couple of weeks. A lot of money rotating away from large cap growth. And I already showed you the Mag 7. I mean, I think you can see it on those charts as well. Now, if you go look at the large cap value, look at the difference in the chart, especially so far in the month of February. But we went down in December, back up in January, and then we kind of been holding our own in February. This is value. And then you look at growth, which went down a little bit, but not a lot. We saw value going down a lot more and growth kind of hanging in there. And now here in just the last couple of weeks, especially during the month of February, we have seen money rotating out of growth and into value. I think that's pretty clear. So what does the ratio look like? Well, here is IWF versus IWD. And I want you to look at the ratio this year in 2025 and tell me what you see. I mean, I'm seeing a really big drop right now with the market going down. We saw this at the beginning of the 2022 cyclical bear market, and we saw some minor bounces and then more selling, and then a lesser bounce and then more selling until we finally ended it. Well, so far we had one little move down, we had a minor bounce, and now we've had a lower low, but we haven't really broken this uptrend. So I think it's going to be key coming up. What happens over the course of March? During the next month, we got a big Fed meeting coming up. Big Fed meeting. I think this could be the biggest one of all. I think this one could have the potential of saying we got a little pullback, or we have a possible cyclical bear market on our hands. I think it could come down to what the Fed does and what the Fed says. And I mean, even at this point, no matter what they say, you got to wonder if they're going to pull back and say something else next month. Just unfortunately, the way the market works, the way the way that this Fed works. Not all Feds, but this one's been all over the place. Anyway, so I'm really interested to see if we do rally. We got a lot of those reversing candles on Friday. So if we do rally a little bit next week, do we see this really make a sustained move to the upside, this ratio? Or is it just one of those little minor, the S&P goes back to where it was, a week or, prior. Maybe it goes back to 6,000, but you get just a minor move to the upside here. That wouldn't look good to me. So I want to see money rotate back into growth. And I have my doubts. I just have my doubts how much more we're going to move back to the upside and the growth. If you're in Palantir, which is $124 was 10 days ago, and now it's at 83, and you're like, well, when it gets back up to 120, I'll get out. Well, no, you're going to see that. Be careful. You might get a bounce to 95. I just don't see, or maybe 100. That's kind of where it went initially and kind of sat there and then dropped. We'll look at that one in a minute. But anyway, this is one sustainability ratio I'm watching. The other one, discretionary versus staples. I talk about this all the time. These are two of the most important charts and sectors that there are out there, in my opinion. What is going on in consumer discretionary? What's going on in consumer staples? Folks, if we go into a recession or the market starts thinking about a recession, you're going to see a lot less demand for discretionary items. Staples, nothing changes. If you're worried, consumer confidence drops, you don't go into your local grocery store and say, you know what? Consumer confidence is waning. I'm not going to buy any soap this week. Everybody buys soap. At least I hope so. I'm not coming over if you're not buying soap. You got to buy soap. You got to buy toothpaste. You got to buy deodorant. You got to buy the things that you need. That's what consumer staples companies sell us. And so when I start seeing consumer discretionary going down, and I think it's pretty clear, A, down, B, back to the upside, C, down. This is a big ABC pattern right here. Correction to the downside in the XLY. We were at 240. We got down to almost 210. Folks, we already went down more than 10% consumer discretionary. So you might look at the S&P and say there's been no correction. We're only down 5%. But there are areas of the market's already had more than 10% correction. Consumer discretion, one of them. Now let's look at consumer staples. What the heck is going on here? Look at February. Second half of January and throughout February, we went all the way back up, set a new high. Again, let's take a look at the XLY. What's going on here? Down, lower high, new low, ABC. We did rally in the second half of February, similar to staples, but I say February anyway, second half of January, we rallied just like we did in staples. But in February, this has been straight down. Money is rotating out and the volume's been picking up. I'd argue that Wall Street's been shedding many of these discretionary names and turning around and buying. Look at the volume picking up here, buying staples names. That's not good. I mean, I'm going to go forward here and I'm going to show you the XLY XLP ratio right here. It looked really good going into the fourth quarter. And then starting in December, things have just changed. And we've had this big drop in discretionary versus staples since probably about the third week of January, pretty close to when I started seeing signs that I wasn't comfortable about the market. And I really thought that we could see weakness ahead. And look what's happened. So if you're in balanced portfolio, you probably haven't been hit too much because, yeah, you're losing in your growth stocks, but you've probably been gaining in many of your value stocks. But this can be the start of a much deeper correction or maybe even cyclical bear market. So this big drop, I mean, look at the drops we saw right before the 2022 cyclical bear market started. Money was rotating out, which is kind of what I started talking about as we approached February. And then in early February, middle part of February, we got growth going down relative to defense, growth versus defensive stocks, or aggressive versus defensive, growth versus value. That's what I was looking for. Growth versus value started deteriorating while the market was still hanging up near its high. Now, what have we seen? The S&P actually lost 5% before bouncing on Friday. So we're starting to see a little bit more deterioration. And I think the ratios are going to tell us a lot in coming weeks. When we get a bounce, how much do we bounce? And when do we start to roll over again? Because when we start to roll over, that could be a sign that we're about to take another big tumble. So if you're in a lot of growth stocks and you're getting we get a nice bounce maybe over the next few days or a week, and you're worried throughout March, that bounce might be an opportunity just to lessen some of the losses maybe that you've seen over the past month and get a little bit more defensive or just sit in cash. Like I said, I don't think things have ended just yet. Could that have been it? It could have been. I don't think it is, but it could have been. I mean, market can always do, I'm looking at odds. I believe the odds are greater. We're going back down again, even if we do rally this coming week. But anyway, those were a couple of really big charts that I wanted to go over with you. I do want to show you one more thing. Here's the Palantir chart. So this is where we topped. By the way, this was the Tuesday before options expired, monthly options. So February monthly options expired 3 days after this high was set. The other thing that happened that day on February 18th, that Tuesday, we had our Max Pain event for members. And when I tell you we do a lot of research and that we help to try to manage risk, this was a perfect example. Palantir was a stock I featured on that Tuesday, showing that Max Pain, the point at which market makers would pay out the least amount of option premium, was $83. And here we were sitting at 124. Now, I said back then, do I think Palantir is going to $83 in the next 3 days? I said, of course not. I said it's a directional clue. It's telling me anyway, that market makers have the incentive to short Palantir, short over a short period of time to bring prices back down so that they pay out the least amount of options premium. And I'm going to show you exactly what that looks like. Give me 1 second because I need to bring up, I'm going to stop the screen share for just a second. And I'm now going to share I'm not sure why it's not showing. I'll tell you what, I'm going to share my entire screen. Tyler, are you there?
Yeah, I'm here.
All right. I think I'm going to try sharing my entire screen, and I want to pull up an Excel spreadsheet. So just tell me if the Excel spreadsheet shows up when I bring this up. Hold on 1 second. Can you see it?
Yep.
Okay, cool. All right. So this is Palantir. This was the price. This was done Tuesday after the market closed in option expiration week, Tuesday, February 18th. It was right after a holiday, right after President's Day. And so this was being evening. Here was current price, and there was the max pain price that I calculated. Now, what I did is I went over to the CBOE and I put on the spreadsheet manually all of the number of calls at every strike price and all of the number of puts at every strike price, and calculated the in-the-money call premium and in-the-money put premium based on that $124 price. And so I'm just scrolling down to show you all these different strike prices. And this is where we were. So right here, Palantir was trading at 124 and change. So every strike price at 124 and below had value. That if Palantir closed on Friday at the same price and there were no change in the options, of course we were going to have changes, but what we do is we calculate based on that Tuesday close. If we saw the same exact situation as of Friday's close, this is what market makers would pay out. Just on Palantir, one stock, $1,387,000,000 on the open calls, 669,000 on the open puts. So here was the strike price. There weren't many puts in the money because Palantir had been going straight up. So most of the puts were puts that had been, bought in prior weeks, prior days, prior weeks, when Palantir was much lower. So all of those options are underwater. They were pretty much zero or close. They weren't zero because it still had time value. But based on this analysis, they were zero because the price was at 124 and change. And remember, I'm assuming that's what it's going to be Friday. So if you're holding a put at 124 and we close Friday above 124, then there's going to be, right here, there's going to be no value in the puts. So anyway, this was the total call premium and put premium. This was the net, and this is the total absolute value. So if we closed at 124 and change that Friday, based on the exact number of calls and puts that were outstanding when we reviewed it, we would have paid out total of both calls and puts $1,388,000,000. Now, when I say that max pain gives us a directional clue, it doesn't eliminate $1.38 billion. But the max pain that I put up here at 83, this is the max pain calculation. This is taking the same number of calls at every strike price, the same number of puts at every strike price, but let's say the price of the stock goes down to $83. What would happen? Now, again, did I think we were going to drop $41 or, roughly a third of the company's market cap in 3 days? No, I did not. But I did think that there was an increased risk that Palantir would start moving lower to wipe out some of that almost $1.4 billion. So if it got down to $83, I want you to look at what the payout would have been. 441, almost 442 million to the folks holding the calls. So you'd wiped out almost $1 billion of call premium. But by going down to $83, you would have had to pay out a lot more put premium. That would have gone up to 354 million versus less than 1 million. But look at the total on an absolute basis. If you add up the value of what you pay out in calls, the value of what you pay out in puts, and you simply add the absolute value of both, 796 million, almost 800 million. But it was almost 1.4 billion before. So just by the stock, if this stock had moved down to $83 within 3 days, market makers stood to gain $592 million on one stock. Now, did we go down to $83 in 3 days? No. But we did go down, and I'm going to pull this up. Hold on one second. Actually, there. Okay, so if you're looking at Palantir, we didn't go down to $83, but by Friday, guess where we were? We had closed back down at the top of gap support, and basically on the 20-day moving average at 100, fell $24. So I don't know what the savings were, but I know market makers saved a ton. And by looking at the chart, you never would have thought anything. You think, oh, well, the stock, went up a lot. It just came down to its 20-day. Nothing to worry about here. Oh, there was plenty to worry about. This is what happens sometimes around monthly options expiration. It's why we do this event every Tuesday of every month, just prior to the third Friday of the month, because the third Friday is options expiration Friday, monthly options expiration Friday. So anyway, just wanted to point that out. I thought it was pretty interesting. You could try a 30-day trial, come on board, and come into our next Max Pain event at no cost. I mean, you got to put up your credit card for that one. If you go back to EarningsBeats, it's here. Well, actually, it's here. You start your no-cost trial. 30 days. You do give credit card, and we'll let you know before your 30 days is up. We'll reach out to you so you don't forget about it. We only want you to be a paying member if you want to be a paying member. Anyhow, that was last week. And some of what we've been experiencing. Again, just to conclude, I think we have a chance for a rally early this week. If we don't get one early in the week, it just, to me, is even more bearish. But if we do get that rally, get back up to moving averages, maybe rebound on some of these Mag 7 stocks that have gotten beaten up, maybe Tesla get back another $10, $15, $20. I think that could set up for another leg to drop later as we head toward the Fed meeting later this month. Anyway, that's it for me. I certainly appreciate everybody tuning in. Hit that like button and subscribe to our channel. That will really help us with all the algorithms at YouTube, trying to help us anyway, try to help us build our community here. We're trying to reach out, meet and help more folks in our community, try to navigate the market. There's so much to learn. I'm trying to learn every day, but there is a lot to learn. And again, at EarningsBeats, we try to do a lot of research, a lot of stuff that our competition simply doesn't do. And so I think you give us a try and you're going to be pleasantly surprised over the course of the year. I mean, if you've been watching me for the last 6 weeks, you've heard me talk about being very, very cautious this market. And now you're starting to see what can happen when these bearish or cautious signs start to flash. Anyway, have a great rest of your weekend. Happy trading.